asset class that we are in right now, which is equities. So the last couple of years, I'm talking 2016 and 2017, were unnatural because of the fair bit of liquidity that was sloshing around in the world in terms of money moving into equities, and that kind of supported, led to a situation where there wasn't too much of volatility in the markets. Not just the global liquidity flowing into equities, we had also, because of demon, a lot of financialization of savings, leading to a lot of money moving into equities from the domestic households also. So it was a combination of both overseas equity flows as well as domestic equity flows, which kind of helped the market lead to a very low volatile situation, which is an unnatural situation. If you look back in history, typically in a year you would have 2-3 corrections which are 15 to 20% in percentage terms. So I think what we're seeing now is normal for equities. Volatility is normal situation.
Pardon me, but I want to ask a question here. Is that, yes, as you're just saying, but if we add up the other asset classes, you have not made 10% returns in any of the asset class. And if you look at the volatility again across the global markets, and for us again partly because of global markets also, is this something which you think is going to settle down as we move towards 1 or 2 quarters down the line, or we are in a period of very high uncertainty?
See, I think the asset class returns are typically not linear. What happens in equities is that you get great returns in very short periods of time, and there are periods of time where either the equities are going down or they're flat or whatever. So I think if you look out into the next 12 to 24 months, I think we had discussed this in the past, I fear that we will probably see volatility with a downward bias.
Right.
Not so much to do with domestic factors. I think domestic macro has actually improved in the last couple of weeks, be it from a crude perspective, which has come down from about $75 to below $60. We have INR, which is kind of from a depreciated number of 74, 75, it's come back to 70, 71. We've had yields come down from 8.2 to maybe like 7.4, 7.5.
Again, it has been a sudden change.
Yeah, it's been sudden change, but that's the nature of the beast in one sense. So I think macros are looking good. Earnings will probably feel a little bit of pressure going forward because I think growth needs to be kind of cut. Growth has already been cut by us. We think that FY19 we're going to see 7.1% growth. RBI is talking about 7.4% GDP growth.
The GDP growth. And what about the Nifty earnings growth?
See, we don't cover all the Nifty stocks, but if you go by what we're seeing in the market, we think that index earnings growth will still be cut a bit going into the second half of FY19, because the Q3 from a consumer standpoint hasn't been too great.
Right.
Okay. We have a situation where the festival season has actually not been too good. You look at auto numbers, you look at consumer durable numbers.
In fact.
It's been fairly, tepid in one sense. So people were expecting some blockbuster numbers to come through from Q3 because a lot of the festivals are kind of clubbed into Q3. But that I think is not going to work out right now. So I think there'll be further cutbacks in earnings. FY20, my sense is that there could be some global factors which could probably lead to a situation where earnings will have to be cut back a bit. So I think despite that, my sense is that you'll probably see low teens to mid teens kind of earnings growth both for FY19 and FY20 combined.
Oh, when you say mid teens, it's like between 10-15%?
Yeah, quite possible. So I think right now if I look at what the numbers are for consensus for FY20, I think index earnings growth is something like 20-25%. I think that is going to be probably pared back to maybe like 15%. Is the sense I have, going back, it's a rough sense. So I think we will, but still that's good. If you look back over the last 4-5 years, we've seen index earnings growth in the mid-single digit territory, or even the low single digit.
Right, so even 15% will be a very good outcome after what actually we are hearing in the third quarter in terms of consumption numbers.
So yeah, so I think that is largely driven by the base effect in corporate banks.
Right,
because we had very large provisioning made in corporate banks over the last few years, and even in first half of FY19 we've had a fairly large provisioning number, though it's been kind of coming off quarter after quarter. But you go into FY20, I think there's going to be a benefit of the base. I don't think the provisioning is going to be as large as what one has seen in FY19. So to that effect, I would think that there's going to be a fairly sharp bounce back in profit after tax for some of the corporate banks. So it's that delta which is probably adding to the earnings growth that one is seeing. So this is, the write-off should have been taken much earlier. If the whole problem actually started in 2009, 2010 time frame, and we didn't take those hits at that point in time. It has taken us a long time to actually unwind recognize the whole NPA problem. We've done it now. I think so. Some of this is kind of coming back-ended. The earnings growth is actually coming back-ended. I'm a little disappointed by that. It should have actually come a little earlier. Had that happened, my sense is that we could have seen index levels much higher than where they are right now. Because if I look back in history in 2003 to 2007, 2008 time frame, you had almost like a 25 to 30% earnings CAGR, and also you had a PE multiple expansion.
Absolutely.
Whereas now we have only had PE multiple expansion. We've not had too much of earnings growth.
Right, earnings has not caught up.
And earnings growth is coming towards the end of the global equity bull market, so to speak. I mean, if you think that US equity markets are going to undergo some kind of a correction,
when you have a risk of PE compression, if
so I think I don't believe in this whole decoupling story that people talk about, that Indian markets are going to get decoupled from US markets and some of the other global equity markets. This is a story that has been talked about even in 2008 2009 time frame. People did talk about decoupling. I doubt whether that is going to happen, because we've had a massive stimulus given from the monetary side and some unusual methods being used. The whole QE thing is an unusual thing, and my sense is that that would have probably created bubbles of various sorts which you're not aware of right now. Once the whole when the tap is shut and you actually suck out liquidity from the system, my sense is some of these bubbles are going to burst, and we'll only know about it in hindsight
when it happens.
And when that happens, my sense is there's going to be collateral damage. And I doubt whether Indian earnings or Indian PE multiples are going to survive from. I think they're going to be impacted equally or probably more. I don't know. Depends on.
Let me take it as a pinch of salt here. So when you're talking about 15% earnings growth again, which perhaps could be met, or we could actually have some surprise in the fourth quarter, primarily because of elections.
Even FY19, I think you should be. It's probably in the bag. I don't think there's so much of a risk to that.
And FY20, do you think another 15%, or it could be much stronger?
I think 15% is what my sense is. As I said, consensus is probably in the 20-25% category. My sense is it will probably have to be paired, but I still think that we could potentially deliver a 12 to 15% kind of earnings growth in FY20. The whole thing in FY20 will be PE multiple.
Right.
I think that is where I think the bigger question needs to be asked. My sense is that will probably see some bit of compression.
So it's all going to be about stock specific, and index perhaps we are somewhere on fair value. Is that an aggressive statement or a fair statement?
So I think if you look at where index P multiples are, probably they are at 17, 18 times forward, and they are probably slightly above long-term average.
Right.
I mean, if you look at the range of PE multiples that the market has traded at in the last 10, 15 years, that's been like, I think 10 at the bottom and probably like 20, 22 at the top, maybe slightly higher than that at the top. So that's the range. So we are probably closer at the upper end of the range than lower end of the range. So if you think that it's a volatile market which is going to be with a downward bias, my sense is going to be probably shifting that range, the PE multiple to the lower side is the way I would look at things.
So we have to focus on stocks then, and for that reason I have to ask you stocks here. So let's start talking about stocks, and let's first talk about, since we were talking about financials, and whatever reasons again I can attribute to financials have a much higher weightage in index, so financials again actually are on the recovery path. There is sort of NPA recoveries which are happening. Credit growth is picking up, needs more steam. Maybe FY20 is going to be better. So what do you like in the financial space at present?
So financial space, we like private retail banks, your HDFC, IndusInd Bank. We like the private corporate banks because I think a lot of the pain is out of the system, or a lot of the poison is out of the system, in the sense that a lot of provisioning on the asset quality side has actually happened.
And the base is very attractive.
And the valuation is attractive. We think that there's going to be ROA expansion that's going to be there, that's going to happen. The other thing is that my sense is that if you do see a lower growth in India going forward, for whatever reasons, for global reasons or whatever reasons, my sense is that the corporate lending part is not going to come back to bite, because we've not seen too much of corporate lending growth happening. So we've been actually providing for all the bad assets on the corporate lending side, so that may not come back to bite you. You'll have to look at how the retail book is going to play out, and the company we like there is ICICI Bank, and it's about 60-70% of the book is retail, of which about 50% of the retail book is probably is housing. We don't see too much of an issue there as we speak right now. So I think it's reasonably well protected. So on the private corporate banking side, we like ICICI Bank, we like Axis Bank, and in the NBFC side, we like those NBFCs where there is pricing power.
Okay.
And from that, I mean, a gold finance company like a Manappuram or a Muthoot is something that we kind of prefer over some of the housing finance companies, where we think the margins are going to get squeezed for various reasons. I mean, we've had a situation where wholesale rates were going up, and there was a potential situation of margin compression that was going to happen out there, and there could also be asset quality issues because some of the developer loans could potentially be coming under question because real estate as a sector has not really picked up steam. So there are those issues that one will have to contend with on the HFC side, whereas we think that, you know, a gold finance company where there's a collateral which is fairly liquid, they've tweaked the business model to actually you know, make it more robust, the business model more robust. These are companies with 4 or 5% ROAs trading at something like 1.5% price, 1.5 times price to book on FY20, FY21. So I think they're fairly cheap, and the growth has been the issue with the gold finance companies is the growth has been missing. But I think last couple of quarters we've seen actually growth pick up for, say, Manappuram, for instance.
Even for Muthoot, the loan book is at an all-time high.
So I think that is probably going to be the driver. So I think the ROAs are good. You have a collateral which is good, which can be liquefied if there's a problem, and you have some growth coming back. So, and valuations are okay. So these are the three pockets I would probably recommend.
Which one do you like in terms of the gold finance companies?
If you ask me, push me, I would say Manappuram versus Muthoot. Manappuram is what I would prefer.
And can I try asking you that why do you like Manappuram more versus Muthoot? If it's possible.
So I think Manappuram has shifted its, you know, the way it accounts for loans from a 12-month model to a 3-month model.
Right.
Whereas Muthoot is, I think, it is kind of tweaking. It has not done that as yet. But I think it's kind of accounting for it on a quarterly basis, the interest part. I would think that the former, the
adjustment is already done. So now you have the.
I think that the other is that I think while you can look at the in a very different way, I would think the Manappuram is actually diversifying a lot faster.
Okay.
It's getting into a lot of other areas, be it housing, be it there are tons of other areas that kind of focus on microfinance. Yes, there are risks associated with, but over a longer period of time, we think that you know, that's probably a diversified business model.
No impact from the commercial paper and entire sort of funding with respect to new businesses. The margins, no impact from there.
See, that's the good part of this business. I mean, you make some obscene, you know, yields on your assets in the gold finance business. I mean, this can be between 20 and 25%. So that masks all these kind of pressures that come through on your cost side. So while your cost may rise up maybe 100, 200 basis points, you can pass that on. And therefore, I think delivering a 4 to 5% ROA should not be too much of a problem for these companies, whatever be the interest rate cycle we are in. How much I won't say it's going to go up very dramatically, but 100, 200 basis point increase in the cost of funds should not be so much of an issue for these companies to pass on to customers. And
one question, just for the interest of viewers again, if you're actually saying that 1.5 times book value is relatively cheap, where do you think these valuations have the potential to inch forward, given return on equity performance or ROA performance? Can they actually move towards the 3 times? Is that something you think is relatively possible, or that's a tough ask? 2 times is a better choice.
So if you look back in history, I think some of these companies have traded at 2.5%, 2.5 times and higher. I think 2.5 to 3 times they've actually traded in the past. So
2.5 to is a possibility.
2.5 to 3 times is quite possible. I mean, they've done this in history, done this in the past. So I'm assuming that may potentially happen.
Right. So like few quarters of growth and the valuation multiple can again go back.
So it all depends on the market. I mean, if the market is good, then obviously it's going to do that. If the market is not going to be good, obviously there's going to be collateral damage on the price to book multiples of any company.
Then sentiments go down for everybody.
Yeah, absolutely.
So that's Manappuram again. You like it. In terms of you also like City Union Bank.
Right.
So what is sort of liking for it? Where it is right now? Your target also on the stock, and how do you think over the next 2-3 quarters, in the context of whatever is happening, the RBI sort of statements, the norms, and then the credit growth, how it is looking to you?
See, City Union Bank is a bank which has got a 100-year pedigree in the sense that it's been around for 100 years. So it's seen cycles. And one thing I like about it is that over these cycles, at least in the last 15-20 years, if you look at the ROE of the bank, it's been upwards of 1.5%. So this is a company which has done fairly well through cycles, which is the admirable part. This is a company which is largely Tamil Nadu based or South India based. 50% of its branches, I think it's got about 600 branches. 50% of its branches are in Tamil Nadu. Another 25% are in South India, and outside of South India is probably about 25%. So it's trying to diversify that geographically, but right now it's more of a Tamil Nadu based player which is focused on SME lending. What we like about is the fact that it has delivered an ROE of 1.5% plus over cycles, largely because both on the asset side and the liability side it has been fairly granular. Be it on the asset side, you don't have it doesn't do too much doesn't corporate lending. It is largely retail lending and small SME lending, and the yields that you get on that is fairly high. On the liability side also, it doesn't do any big ticket, it doesn't take large term deposits and stuff like that at very high cost. It's been able to control the cost aspect on the interest side. OPEX, it's been a phenomenal company. The cost income ratio is close to 39%, or maybe between 38 to 42%. Various things in terms of the average age of the workforce. It's not part of some of the IBA related negotiations that happen on wages and stuff like that. So it's also digitized quite a bit. In fact, 90% of the transactions are digital transactions that are being done. So that's phenomenal versus something like 60% that it used to do a few years back. And at 90%, it's probably in the ranks of some of the best digital banks, online-based banking platforms in the country. So some of these things have led to this 4.5% kind of NIM being delivered by this company. And the asset quality has been reasonably good despite the fact that it is addressing an SME segment. The recovery ratios have been fairly good. So all this has, in my opinion, it is not cheap. It is not, by the way, market is also very smart. So it's trading at 2.2, 2.3 times book, but not in the league of, say, a 3.5 to 3.6 times book for some of the other quality players like an HDFC Bank or some of the other players. So it's not as cheap as an ICICI Bank.
But why do you think it's not trading at the valuation multiple similar to other peers when the performance has been so good?
I think it has to do with, an HDFC Bank is probably a far more diversified bank and across geographically products, whereas this is more like an SME focused bank, largely a Tamil Nadu based bank. I think it is, people are looking at those aspects, and there is, I'm not in a position to answer you why 2.2 can't go to 3.6, but I think there's a fair chance that I think it is traded somewhere close to 3 at some certain points in time, so it can potentially go there, is the way I see this particular company.
But you don't perceive any sort of risk coming from the SME segment? I know, as you were explaining, the history has been very good for them, but in the context of the GST implementation, in the context of what the commentaries have been coming again from the PSU banks, again they're seeing the risk which they are seeing at present is only in the SME and MSME category at present, and the rest categories are either improving or looking better. So do you foresee any sort of risk from that part of market, or at present the commentary is still looking quite good?
See, I think the NPA levels have been slightly higher than that of some of the banks I talked about, HDFC Bank, for instance. Definitely higher. Probably that is one of the reasons why it's trading. But GST, in my opinion, is actually going to increase the size of the market or the opportunity for a bank like CUB, because if you have SMEs filing returns, you have a trail which can be used by a technology intensive player like CUB to actually access more SME customers going forward. So in my opinion, GST coming in is actually good. Maybe in the very short term it may be a little painful, but from a long term perspective it actually increases the opportunity size of an SME player, lending player like CUB. And obviously, you are able to keep track of cash flows a lot better under the GST system.
But right, on the current asset quality trends, you don't see any sort of alarming risk or any spike at present?
No, I don't think that, at least from the company's commentary, it doesn't come out at this point.
What's the target price you have on the stock?
So I think the stock is probably trading at 170 to 180 rupees. I think we're probably at 200 plus. I don't really recall exactly what.
Fair enough. Again, at least 10% plus is what
definitely. I think
is
probably
the
closer to
potential
15 to 20% is what I think our target price is.
on the stock. Okay, so that's City Union Bank again, where again it's a sort of stock which, as Mr. Pai was explaining, has a more SME exposure and is a sort of niche player in the South India again. So that's one financial stock we talked about. But let's talk about one stock which we've talked about in the last two shows again. That's the leisure stock, Inox Leisure. You have been liking the stock. Now, one question I want to ask you again. So from financials, we have now moved to entertainment here, and let me ask you this question here. Of late, we have heard again from the players again. There are a handful of players in this space again. So you have Inox, you have PVR, and then again there are two smaller players. So on the Inox side, how you're looking at the moat at present? The company has been announcing some aggressive investment plans. They want again to investment and expand the capacity. We heard from PVR they want to launch a sub brand for the tier 2 and tier 3 expansion. From that perspective, where the stock is right now in terms of its moat, in terms of the sort of returns, how's it looking to you? So, and let me add this: is it progressing as per your expectations for the year?
Right. So it has been delivering on the numbers. Q2 was a little soft because I think they had some issues with Book My Show. Where the contract with Book My Show came to an end somewhere in I think month of September. So for a few weeks they didn't have Book My Show as one of their ticket aggregators. So it lost some customers because of that. A few lakh tickets weren't sold because of that. So they had that impact. But otherwise I think it's broadly along expected lines. So why we like the film exhibition space is that within the consumer discretionary basket, I think it's probably among the cheaper set of companies we have to invest in. And we like it because it is a kind of an oligopoly. Four players. We talk of Inox, PVR, Cinepolis, and Carnival having something like 70-75% of the market. And we think that that particular space can consolidate a bit more going forward. We think that what is also happening is some of the new malls that are coming up, the theaters in those malls are actually going more towards Inox and PVR. So even organically, forget about the inorganic part, even organically my sense is that the mall operators are giving more of their the space to an Inox or an PVR vis-a-vis say a Cinepolis or a Carnival. Carnival is more of a peripheral player right now. It's not so much in the tier 1.
Why is that so? Like why these guys have a competitive advantage? Why they are going?
I think they built the brand in one sense. So I think PVR has been fairly good at brand building, and top of the mind recall is much better for PVR even versus Inox. So Inox has also been doing that. So see, if you look at the operating metrics of Inox versus PVR, why we like Inox right now, we like both companies. I should state that right now. But we think from an upside perspective, Inox right now has got probably a 65% upside to my price target versus 25% kind of upside for PVR. So
what's the target for Inox? Let me ask it again.
Inox will be about 360 or thereabouts.
Okay.
Why we like it is because one, it's trading at a cheaper multiple than PVR is. I think versus something like 12 times for FY20 EV EBITDA multiple, we have Inox at probably 7.5 or 7 or something like that. My sense is that the operating metrics of Inox will improve. They are probably on the ticket price side, it is probably 10% discount to PVR. On the spend per head from an F&B perspective, it's probably 25% lower than PVR. And on advertisement revenue per screen, that's about 40-45% lower than PVR's number. So I think some of these metrics are probably going to work as we move forward. I think Inox will probably bridge that gap. I'm not saying it's going to bridge that gap completely, but some of that, the very large 25% on SPH and 40-45% on advertisement revenue per screen, I think that is going to get crunched, which will probably drive a faster EBITDA growth for Inox vis-a-vis PVR in our opinion. And I think that is one of the key things that we've been pushing. Right now it is not getting reflected in the stock price. Both stocks got hit when this whole F&B controversy kind of came through. PVR has been benefiting from the perspective that they went and made a very decent sized acquisition down south, and 2.0, I mean, Mr. Rajnikant's movie has been a big hit, so that probably people think that PVR is going to benefit more than Inox, rightly so. But Inox has also been doing its own thing in the sense premiumizing screens in Bombay, kind of becoming a very strong player in South Bombay, for instance. So I think the ad revenue per screen, which has probably got about a 90-95% gross margin, that advertisement revenues, I think, will probably grow a lot faster for Inox. So broadly, that's the picture on these two companies.
Absolutely. I think we would have loved to actually continue our conversation. I think some more ideas to discuss, but we are completely out of time. So I think fair to say, so Inox Previa, you like the both, and Inox again at present is the more preferred bet here, and that actually summarizes our the entire discussion on the stocks and the sectors and the markets. So Mr. Pai, thanks a lot as always for coming on the show and giving us all the insights on the stocks and the markets here, and that brings us to the end of this edition of Market Guru. Thank you so much for watching us.